Hi everybody, welcome back to Banking Simplified, where we try to simplify complex banking terms and understand them easily. So I want to ask you one question. You all get salary slips at the end of the month that we all wait for eagerly, right? So you get the salary slip and you know that this is my earning for the month and for the year for whatever work I have done. Now in banks, you all work in branches, so for your branch or for your particular unit or for the various departments in a bank, how can you make out what is the earning for each department or each branch, or how much are they getting the credit for the work that they are doing? So to understand this particular thing, there is a concept called funds transfer pricing. And funds transfer pricing lets us know that which unit has got how much of the credit for the work that they have done. So that is one question. Now, supposing your branch has got some deposit, has somehow managed to get a lot of deposits for itself. Then the head office takes his deposits and puts it out for lending. Now, who should get the credit for that deposit that has been brought to the bank? So, all these kind of questions can be answered through a mechanism called fund transfer pricing. But before we go and understand this particular concept, we will first try to understand the organization structure of a bank. Since you're all working in a branch, so of course you have the knowledge of the branch. You see the bank through the branch, isn't it? Now, today I want you to see the bank as a whole. But before that, let's look at this small video. So, what did you understand from the video that you just saw? It was basically, I had tried to show you the human body, just like us, so that it's easier for us to correlate. So in the human body, the first thing that you see that in the brain, it's the board of directors. So let's connect the structure of a bank to the structure of a human body so that it becomes easier for us to relate. So the brain, where all the strategies are happening, where you're trying to make future plans, you're trying to make long-term, short-term, medium-term plans, strategizing everything for the bank as a whole, is your board of directors. So the board of directors comes at the top, who is making all the top level decisions for the bank. So that is like the brain for the body. Then second is the heart. The heart is pumping blood to the entire body. Similarly, the treasury of a bank is pumping money to each and every part of the bank. So the treasury is basically, what is it doing? It is borrowing money whenever required. It is borrowing money from RBI, borrowing money in the interbank markets, from the money markets. Whenever there's a shortage, they are making sure that the money is being borrowed. If there's excess money, they are making sure that you're investing in the right places so that you get the required returns for the bank. So treasury is the heart of a bank. That particular department which is basically pumping out money to the required places, investing money so that you get the required returns. The lungs, basically the risk and the compliance department, are keeping the system clean. Just like the lungs are keeping our body clean, the risk and compliance are making sure that you are complying with the RBI regulations, and whatever risks are coming to the bank, it's making sure that it is keeping the system, the bank, clean by keeping away those risks at a distance. Then comes the nervous system, which tells us, whenever it tells the body, whenever something is going wrong, the nervous system will come and tell the body. Similarly, the audit, if they think that there's something going wrong in the bank, in the branches, or in any of the departments, for example, you have branch audit in your branches, right? So it basically tries to keep the gaps away. It will show you that these are the gaps that you're facing, you're not following the required guidelines, and you need to make amends to be able to be in sync with the bank's requirements. So that is your nervous system. Now finally, since you all are in the branch, I would like to ask, now since you understand how I'm comparing the body with the different departments of a bank, I want to ask you that branch, what do you think is the organ that you can relate to the branches? It is your hands or your legs. Basically, this is the hands are which are in connect with everything. So the branches are basically in connect with the customers. The branches are the ones which are doing the actual work. Your hands and legs are actually doing the work. You're moving, you're interacting, you're talking, meeting people because of your hands and legs. Similarly, because of the branches, a bank is getting the business they want. A bank is getting the profits they want. So the branches are the ones who is reaching out for the business of the bank, for lending, for be it for deposits, okay, be it investment purposes, you're giving out loans, you're giving out investment decisions to the customers. So branches are what plays a major role in the banking system. Now, as I had told you about the key departments in the bank, of which retail banking, corporate banking is there. Retail banking is where you're giving out loans. You all have been doing that in your branches. You give out bigger loans to corporates. Then there's Treasury and ALM. As I said, they will manage the liquidity. It's the heart. So it is managing the liquidity and the funds for the bank. And then there's risk management and compliance, which is another very important function that the department plays, is that it is making sure that all the entire system is clean, in place, and doing business by not taking bigger risks and doing business in a way that it does not lead to losses. And then there's audit and compliance. Audit will again make sure that there are no gaps. So these are the various departments, these are various structures that you need to understand is there in a bank. Now, this is a small picture that I wanted to share with you. Now, this is a game in India that I think we all are very familiar with and we all love to watch this game. There are three things that I will write down here. You can see that there are the players, there's an umpire and there's a referee also who intervenes whenever required. Now the players, who are the players? They are facing the opponents head on. The players are the one who are actually there on the field, doing the work, playing it, trying to win the game, okay, doing all the hard work, trying to gain whatever they can. So those are the players. This is the first line of defense. I've just written 3 lines. This is the first line of defense because this particular line is taking the entire game head on. Then comes the umpire. The umpire will come and see whether he's always making sure whether the players are complying with the rules and regulations of the game. Whether they are, he'll make sure that the risk of the players is very less so that no one gets injured, no one does something that is not right or away from the rules. So this is the second layer, and referee will intervene at the end if there is something, if there's a gap or there's a very big problem and the referee sees that there's a problem, the referee will come and tell that, see, this is what is happening, there is actually a problem, there's a gap. Now these are the 3 lines of defense that you can see in the game, but these 3 lines of defense are also there in a bank, okay. Even a bank has different 3 layers of defense because when a bank is doing its business, it does not want to take a big loss or a big hit directly in the heart, that is directly in the treasury. It will want that it should have some layers. Even when you go in a war, the king is kept at the end, the king is protected at the end, and it has the king has a lot of layers of defense. Similarly, the bank also, the treasury, where all the money is there, the bank is also protecting that particular their head office or protecting the money that they have by creating various layers of defense, okay. So the first layer of defense in a bank, what do you think that will be? which is the first part? When you think of a bank, when you enter a bank, what is the first thing that you hit onto? The branch. When a customer comes in, the first place that the customer is going to come to is the branch. So the branch is your first layer of defense, because the branch has to take all the risks, everything head on, and has to make sure that whatever business the branch is taking is not going to create a loss for the bank, is going to protect the bank. Then the second is your risk management and compliance. This is again making sure that this particular second layer of the second layer is making sure, I'm just writing risk management RM, okay, and compliance. So the risk management is making sure that whatever is happening in the branch is not getting exposed to a lot of risk and is as per the rules and regulations and policies laid by the bank, so that in case somehow the risk percolates or there is something that goes wrong through the branch, if the branch is not able to take a particular risk head on, then there has to be another layer that is sitting there protecting and telling them that, see, this is the risk that you've taken and this is the risk that we are supposed to take. So you need to be careful. Somebody has to be there, be the cushion, and whatever risk has been taken to make profits, because bigger the risk, bigger the return, we know. So of course there will be certain risks that the branch will take. Now to mitigate that or to keep a control on that, the risk management team is going to be there, looking the department, making sure that we protect and keep a cushion for the bank. And finally, the last is your audit. Audit will come at the end and it will come and check whether things are in place, where you have branch audits, okay. So it's the watchdogs. The audits are the watchdogs who will keep looking at all the things that you're doing in the bank and will try to tell you that, you know, these are the things, these are the gaps that you have created, or these are the gaps or problems that are there in your system. You know, when you're giving out, it will come and tell the branches that, see, you're giving out loans, that is okay, but have you done proper due diligence of the borrowers? If there's something missing, then the audit is going to come and tell you that next time you have to make sure that this does not go wrong. And why is audit doing that? Because it is the third layer of defense, protecting the bank from going into losses. It is protecting the bank from going into any kind of loss. So here, this is a very important term that you will hear in risk management. Also, now that you are in a branch, now you will know that there are 3 layers which are protecting the bank, and you are the first layer taking the hit head on. So there's a big responsibility to make sure that when you're lending out, taking deposits or doing any kind of business activity with the customers, then or you're selling something as a sales, as an agent or as a RM, you will be selling out certain products to your customers. You have to make sure that you are taking the right rate of interest, you are choosing the right products for the customers, because you will have to be compliant with the bank's policies and rules. And if that is not happening, then audit is going to point that out for you, trying to protect the bank, and you have to again make sure that things are aligned completely. Okay. Now we come to the last part. So what have we done till now? I'll just give a small recap. Firstly, we talked about the structure of a bank. The structure of a bank is where you have the various departments of a bank. Then we talked about the 3 lines of defense. And now this is a small thing that I asked you in the beginning. The first question that I asked you. So if your branch is getting deposits, is able to get deposits for the bank, let's assume that to be 100 crores. Now you take those deposits, you give it to the head office. Now the head office is going to lend it out to someone and make profits. So now who should get credit for that 100 crores which has been raised for the bank? Whether the branch because the HO has now taken it and invested it somewhere where it's going to get more interest rates. So who should be the one getting the due credit? Now when this question comes in, this is where the most important mechanism comes into play, that is funds transfer pricing. Before we understand funds transfer pricing, I want you to just have a look at this. Now, you go to a restaurant, okay? In the restaurant, you pay your bills. Whatever you eat, you pay the bill for that, right? Now, supposing, let's assume your bill was 1,000 rupees. Do you go and tell the manager that, you know, the chef's share is this much, the waiter's share is this much, and you can keep this much? No. You just pay the 1,000 rupees and you come back. The manager decides who's going to get what. It is the same case here. In a bank, when the profit comes in, when the money comes in, who is going to decide that which department is going to get how much? Who is going to decide how the profitability is going to get distributed within the bank? Who is it? Can you tell me? Because we've already talked about this earlier. We've talked about that particular, the heart. Who's the heart of the bank? The Treasury. So the Treasury is going to decide who is going to get the share. So what is this? This is funds transfer pricing. It is an internal pricing mechanism. What is funds transfer pricing? It is an internal pricing mechanism that assigns funding costs and revenue credits. So the FTP mechanism will tell you that what will be your cost for funding and what is the credit that you get for the funds that you get for the bank. Now I'll simplify this entire concept with a very easy and a very small example. Let's keep Treasury where it is. Now, Treasury, as I told you, will keep getting inflows of funds from various sources. It will borrow funds from various sources, from other banks, from RBI, as and when there's a requirement. Also, Treasury will keep lending funds. Okay, it will borrow funds, it will lend funds also. Why will it lend funds? Because whenever there's an excess fund with the bank, will you keep it with yourself? For example, you have excess funds with you after you get the salary. You get 1 lakh salary, for example, let's say, and 50,000 is your savings. What will you do? You will invest it somewhere. That is what the Treasury does. Whatever is the extra money that they have, they will invest it so that they can get some returns on it. That is another side. Now, let's assume there are two units in the bank. One is your lending unit and the other, let's say, is your deposit taking unit. So the deposit taking unit has been able to get deposits of rupees 100 crores. So when you are taking deposits, you of course know that you will have to give out a particular rate of interest. Now, we are not going to the tenure, the maturity, what is the maturity of the deposit and all. We are just keeping it very simple to understand the calculation, to understand how FTP works, okay. As of now, just understand that 100 crores you have got and you are giving 4% to the borrowers for the 100 crores. Now, after you've got all the deposits will be not kept with the unit. They will send it to Treasury. They will give it to Treasury. Treasury will buy these deposits from the deposit taking unit, let's say at 5%. Because of course, Treasury wants to, what did I say? It is a mechanism, it's a pricing mechanism that will want to assign revenue and costs. So Treasury wants to give revenue to this particular unit. It wants to allocate its profit. Whatever profit this deposit making unit is doing, Treasury will want to allocate that profit to this particular unit so that they have this incentive to get more deposits later. Otherwise, what is the incentive, right? Now 5%. So what is the earning that this particular unit is doing? 1%. They are earning how much? 1%. Easy. Now we come to the lending side. Lending, so suppose they are lending this, they have to lend, oh God, rupees 100 crores. Okay, lending rupees 100 crores at, let's say, 10%. Okay, lending rupees 100 crores at 10%. Now, when this lending unit has to lend, it will need to get funds from somewhere. So, it will get funds from where? The Treasury. Treasury is going to lend funds to this unit, let's say, at 5%. As of now, Treasury is not making any profits here. It is only distributing the profits of the bank within the different units of the bank to incentivize these units for whatever work that they have done, for whatever business they have bought for the bank. Now they have lent this to the lending unit at 5%, and lending unit has lent it to the customers at 10%. So they are getting 10% by borrowing money from this unit at 5%. So what is the profit? Got the funds at 5%, lending the funds at 10%, earning of how much? An earning of 5%. Okay, now what is the total earning of the bank? 5% here, 1% here. What is the total earning of the bank? 6%. So this 6% is actually the total income for the bank. All right, and what has FTP done? FTP has very nicely rewarded deposit mobilization and lending separately. So this 6% has distributed to the deposit taking unit, to the lending unit, and it is a tool, it is a fairness tool that has rewarded deposit mobilization and lending separately. And as a whole, the bank has earned a 6% interest. Now this is where another terminology comes in, which is your NIM, net interest margin. You will see this percentage everywhere. To assess different banks, we use this terminology called net interest margin, which is basically interest earned minus interest paid divided by interest earning assets, which is your 6%. Interest earned minus interest paid divided by your interest earning assets. So that is what I told you. So NIM is what? It is the final team score. The cricket match that we had just seen, and where we had actually talked about the 3 lines of defense. In that cricket, if you go back to that game, to that particular slide and see, it is basically the team score. In a cricket, you have, supposing the entire team has scored 200, right? But Sachin scores, the score of Sachin is different, score of Virat Kohli is different. So different players score differently, and in total, it is the team's score. And that team score is what makes the team win or lose. It's the same game here. So NIM is the final team score. And what is FTP doing? FTP is telling you that how much has the different players earned. Okay? And FTP as a system tells which player has contributed how much to that score. It's a very simple and a very beautiful concept to understand, and it will make you understand how your bank is functioning, because sitting at the branch, getting deposits, giving out loans, if you know how it is functioning, then you will actually know that how these profits are getting distributed and how is your work so important to get these things done, to mobilize deposits, to bring in lending at a particular rate. Why is it so important for you? You will know that only when you understand these beautiful concepts. This is what I had told you, NIM. So total deposit mobilized is how much? 100 crores at 4%, which is the interest expense of 4 crores, right? Interest expense of 4% here. See, 4 crores you've lost. Interest expense of 4 crores. Interest earned is how much? Interest earned is your here, if you see, 10 crores because 10%, this is your interest earned, divided by 100. What is this? Which is 6%. This is your NIM. And what is 6 crores? This is your net interest income. This is the income, this is the percentage. 10 crores is what you had gotten by lending out. 4 crores you had to give out to your depositors. 10 crores you got from your borrowers. Total you have 100 crores of your assets and you get a 6% interest. So this is the concept of NIM that has been shown here. 6% interest. It measures how effectively a bank converts the interest earning assets into interest income. And it is actually a very important indicator. NIM for the bank is a very important indicator to show how operationally efficient your bank is. Okay. Now we'll just do a quick recap and quickly understand what we had done in the beginning. Firstly, the first part was the different departments in the bank, the structure of a bank, where we had talked about the board of directors. Then we had talked about treasury, the risk management, there's compliance, there's audit, of course there's retail and corporate banking. These are the key roles, the key departments that we're talking about. Of course there are other departments like operations, IT, HR, but we were only focusing on the key important ones. After that we had talked about the 3 lines of defense, wherein we had said the first line is you, the people in the branch, because you're taking the first hit of business. Second is your risk and compliance, and third is your audit. Risk and compliance is making sure that you are actually complying with the rules and regulations and you're not taking risks which are out of the policy of the bank or which are too much for the bank to handle. And audit is going to come and tell you the gaps in your processes so that in case there are any problems, you can sort them out, and it works as a watchdog for the entire bank. And finally, we talked about funds transfer pricing mechanism, which is a beautiful tool that allocates the funds to the different units and makes sure that every unit gets the percentage or the share of the overall profit of the bank, which is the NIM, the net interest margin. Quickly, I'll ask you a few small questions so that you know it stays in your mind whatever we've studied as of now. Which department is called the heart of the bank? The treasury. Who ensures bank follows RBI rules? Who's the one which is trying to make the bank comply to RBI rules? The compliance department. If branch raises deposits at 4%, which basically means the branch is paying out 4% and FTP credit is 5%. FTP is buying those deposits from the deposit taking branch at 5%. How much is the profit for that deposit taking branch? Very easy, 1%. So next time when you're mobilizing deposits, you have to remember that FTP is going to ensure that your branch gets the due credit. So you don't have to worry that, you know, we are raising deposits. Where is it going? Where are we getting the credits? FTP is there to take care of that. So I just hope this concept is very clear to you, because it is going to make your understanding of how bank's profitability is working and how the interest income is distributed within a bank. Thank you.